start, we're going to review some of the really basic economic or macroeconomic relationships that we saw in the first course in this specialization, Understanding Economic Policymaking. And this is the first one, this graph, where we're looking at the business cycle in the United States, which if you did that course, you know what that is real GDP growth is normally what we look at. Now, real growth means GDP growth having taken out the inflation. So just to remind you of that, on this first graph, I've put two lines. One of them is real GDP growth, as we've been saying, and you can see that that one, it doesn't say real, it just says GDP growth, because when you read about this in the papers or you go to data sites, often it's understood we're talking about real, the word is omitted. The other line says GDP growth, current prices. That is growth in nominal GDP. And what you see is that nominal GDP growth is above real GDP growth. The difference, of course, is the inflation that's taken out of one to convert it into the other. That's taken out of a nominal to make it real. So you can see that the real GDP growth cycle shows pretty strong growth in the early period. You can see the impact of the 2009 recession, which was a global recession. You can see how important that was in the United States. Then there's a recovery, and it continues fairly stable up to the present time. Let's look at the next chart. Here I've broken down the different components of GDP now. If you're remembering the earlier class, we said that GDP is C, which is consumption, plus I, investment, plus G, government spending, plus X minus M, which is net exports. And so I'm showing you three of these elements. I've left out X minus M on this chart, and you can see how their evolution, their trends over time are really, really different. If you zero in, for example, on consumption, which is private final consumption expenditure growth, notice that this is a pretty stable line. It doesn't go up and down a lot, and that makes sense because when we're consuming, we need basically what we need. We're not going to reduce consumption by 10% one year and then increase it by 10% the next year. We're buying our housing, we're paying our electricity, we're buying our food, basic services. So private consumption tends to be pretty stable. And if it shrinks, as you can see that it does in 2009 just a little bit, this has a huge impact on the economy because consumption in the United States is 70% of the total. Then you see the investment figure, which is gross fixed capital formation growth. And you can observe how volatile that one is. You can see that sometimes it goes up a lot and sometimes it has huge declines as occurred in the recession. And finally, the third line is government consumption. So that's the G in our equation. And sometimes you see this one trying to compensate for the others, like trying to grow more when investment is falling and then recovering and declining a bit when investment comes back and takes an important role in the entire economy. So this gives us a sense of the different dynamics of the different parts of GDP in the United States and in most countries. The last graph shows us something that we also discussed in the macroeconomy course, which is something we've called the output gap. That represents the difference between how much the economy is capable of growing without generating inflation. So it's usually the highest growth rate we can achieve without pushing up into an inflationary situation, and how much the economy actually is growing. So we have two different situations in every country. Sometimes the economy grows faster than its ideal rate. Now, the ideal rate in the United States right now is running around 2%, but it does evolve over time, and there are a number of factors that can influence it. Anyway, imagine that the ideal rate is 2% and the United States is growing at 3%. Then we would have what we call an inflationary gap. The economy is growing too fast, it's generating inflation problems, and policymakers should try to slow it down. On the other hand, there are situations when, again, imagining the United States is capable of growing at 2% without accelerating inflation, so that's its potential. It could be growing at 1%, or it could be shrinking by 2%. In those cases, we would be below the potential and we would have what we call a recessionary gap. So on this particular graph, you can see the inflationary gaps as positive numbers, the recessionary gaps as negative numbers. And notice here that just before the crisis, in the years building up to the crisis, there's a large inflationary gap in the United States. Now, we'll turn to this a little bit later when we think about policy, but you can see how large it became. That meant that, there was lots of growth. The economy was growing faster than it really could. and pressure was building up on inflation or on asset prices, right? Then this situation changes drastically in 2008, and you observe then the recessionary gap where the economy comes down and you see that this output gap shows negative numbers. That means that we're not producing as much as we could. There's slack in the economy. This could be unemployment. It could be factories that can't sell all their output or that are producing maybe at 50% of their capacity or less. So you can notice here how long this recessionary gap lasted. It was a very big one. They're normally not so long. It was big, it was deep, and it lasted for a long time. And you can see finally at the end of the chart, when we come to the present time, after 2017, the U.S. economy is moving again past potential growth and moving into a new inflationary gap.